Hi guys, how's everybody else doing this evening? Hi Monica, hi Prema, my faithful friends, always on. What did I do with my typo? Who else is there? Neba, hi there. Luckily I'm fine, no flu in the household yet this week. Christopher, how are you doing? Are you better now, love? Oh no, you're kidding, you're sick again. No, that's awful. Thanks, James. Is it, what have you got, flu again or another one of these? Yeah, you must really take care, Christopher. You must just, now that there's no more. Oh no. And that's just before the exams too. When do you write your first paper, Chris? Next week, Friday. So you've got a whole week. Hopefully you'll feel better. You must just spend the whole weekend flat on your back in bed. It's the only way to get better, really. It is. Don't go outside at all. Yeah, it's terrible weather all over the country at the moment. So everybody must just stay warm. Okay, it looks like everybody is, there's no more, I don't see any new names joining, so hopefully everybody is online. Yeah, that's exactly why everybody gets sick. We had here in Gqeberha, was it last week? Yeah, I think it was last week because I think it was on my daughter's birthday. The temperature went right up to 30 degrees. And we had 2 days where the temperature was over 30 degrees in a row. And then this weekend, we just had these storms and torrential rains that hit. And now it's cold. And I saw a friend of mine who lives in Maltino. It was snowing there last night and all day today. So always when the season changes, we get this crazy weather. Okay. Okay, I don't see anybody else joining, so let's go. All right, so I'm going to share my screen and then we're going to carry on with our 2023 exam paper that we were that we started last week. There's just 2 more questions left, so we should finish that. Let's go there. Okay. Yeah, I saw, I was watching the videos of, well, they said it was a tornado. I don't know if it's officially a tornado, but I saw the videos of what the winds did in KZN. Crazy. KZN, one more person joining. KZN always seems to get the worst of the storms when we have them. Okay, so Lauren's joined us as well, so we can go. So last week, remember, we're doing the 2023 exam paper. I think I did upload it. Did I upload it into more resources? I think I did after last week's class. And we did last week's recordings, got question 1 to 3, and tonight we're going to do question 4 and 5. So this paper will be split over 2 recordings. Okay, so let me go over here and let's have a look at our question 4. So question 4 is a Learning Unit 5 question. And let's just go to the required so we can see what we have to do before we read the question. excuse me. So here they want us to calculate what the initial list price. Okay, this is what we've got to have to do. Calculate the initial list price per share should be using the free cash flow valuation model. Okay. So I quite like this paper because it's got this free cash flow question in it, because they don't always include it in the papers. So this is a nice one. And then this 8 marks is just a theory question. Explain to the board it should be 4 main differences between the use of debt versus equity to finance a company to the management board. So that for 8 marks was a theory question. And you know, in your textbook you've got that table of debt and debt on the one side and equity on the other side. So in this question 4.2, that's the information they're looking for there for those 8 marks. So let's just go back and have a look at this. Let me just get my textbook. Sorry, it's on the floor here next to me, because I want to refer you guys to the formula sheet. Have you guys got a formula sheet? Do you print it out? Have you got a formula sheet in front of you? Because this is important for this question, because this is the free cash flow valuation formula is not on the formula sheet as such. So if you go to the second page of the formula, where it's got bond valuation, dividend growth model, variable growth model, that whole section where we have got those valuations of the company, you'll see underneath the variable growth model formula, this is on your formula sheet page. Oh, this is not, yeah. Below the variable growth model formula, you'll see a formula that says FCF, which is free cash flow. But now don't get confused. This formula on the formula sheet for free cash flow is the formula for calculating the rand value of the free cash flow for each of the years that they might give you in a question. So what they usually do in that case is they give you income statement information about a company, and then you've got to use that to calculate how much in rand values there is in terms of free cash flow for each of those years for the company. Okay, so that's free cash flow. When we want the free cash flow valuation, which means it's a valuation because we've got to value the shares of the company. So in other words, we've got to work out what the company is worth. Then we've got to use the free cash flow valuation formula. Let me just see if I can find the page number here quickly. Sorry, my family's making a bit of a noise in the kitchen over there. Yeah, so on page 119, more or less, you've got that table of debt versus equity. Quickly just want to find the free cash flow. So if you go in your textbooks to the free cash flow valuation model, it's 5.6. In my old textbook, it's on page 130. You've got example 5.4, which is the calculation of the actual free cash flow, the rand value of the cash flow. Okay, so take a good look at that. So what they're going to give us in this question is we're going to be given the rand values, and using those, we are going to go to 5.6.3, the formula. In my textbook, it's page 133. And that is where we've got the free cash flow valuation formula is as follows. If you look at that formula in your textbooks there, you'll see it's constructed as VO. In other words, the value of the company is equal to, and then we've got one calculation that we do, the sum of the free cash flows over 1 plus R to the T, and that calculates the present value of the high growth period, which is the initial stream of cash flows, initial period. And then there's plus, and then we've got the rest of the formula. And the rest of the formula is then the terminal value, in other words, the present value of the terminal value. So you're going to do two calculations. You're going to take a present value of the high growth period using the first growth percentage that they give you, and then you're going to do a second calculation for the rest of the years using the lower growth percentage that they give you. So if you have a look at that and you go to your formula sheet, on your formula sheet, have a look at the variable growth model formula. Okay, it's the dividend growth model, variable growth model. And if you compare that formula that is on your formula sheet to the free cash flow valuation formula that's not on your formula sheet, you'll see that the two are almost identical. They're identical in their intention, where in both cases you've got the present value of an initial growth period and then the present value of the terminal period. So you can use this variable growth model formula on your formula sheet as a cheat if you get asked for the free cash flow valuation formula. You can see what we're doing, that instead of in a variable growth model, we are using above the line, it says DO times 1 plus G to the T. What we are working out there is what the value of the dividend is. Instead of the value of the dividend, for the free cash flow valuation formula, we are going to use the value of the free cash flow, the RAND value, FCF. And exactly the same in the second half of the formula, where we have got, in the variable growth model, you've got DN plus 1 over RS minus G squared. Sorry, RS minus G2. In the free cash flow formula, you've got above the line, you've got free cash flow times 1 plus G. So we're just, instead of using the dividend RAND value, we are going to be using the free cash flow RAND value. So you can use the formula sheet to help you with this particular question if you get it, because obviously that's a long formula and it's difficult to remember the whole thing. So just remember what you're wanting is the RAND value of the free cash flow, and then you can substitute it into that dividend growth formula. Okay. And then also, before we go and have a look at the calculation, the other thing is that the free cash flow valuation model, the other important thing you must remember with this formula is that the answer is the value of the entire company, debt plus equity. Okay, it's going to, because we're using the whole cash flow, the free cash flow, the answer that we get, VO, is the value of the entire company, debt plus equity. Remember your accounting equation, assets on the left-hand side equals equity plus liabilities. So what this formula calculates is the right-hand side, the entire right-hand side of the accounting equation, equity plus liabilities. When we want a price per share, our shares are equity only, because remember the value of the shares is what what belongs to the shareholders. So that is equity only. So I'll show you in the calculation when we go through the workings what we do with that, but that's just something that you must remember, that when you finished working out the value for VO, that answer that you get isn't your final answer, because you still have to convert that full value, debt plus equity, to an equity only RAND value, and then divide that by the number of shares that you want to issue to get a price per one share. Okay, so let's go and have a look at what information they gave us. We want to value the shares of Legend Pty Limited. It's an unlisted company. So it's unlisted, which means that we perhaps are going to do a brand new listing and what they call an IPO, initial public offering. And in order to do that, we've got to work out what price we should offer the shares at initially. So they're considering becoming listed on the JSE, and we've been requested to determine what that initial list price per share should be. The company's other sources of capital, so that means other besides the money that we are going to raise by selling shares, which will be equity, the company also has capital of corporate bonds. So we know that corporate bonds is a form of loan that the company raises, so that's debt. That's got a market value of 16.15 million. And we've also got preference shares with a market value of 9.75 million. So also remember that preference shares are what we call a hybrid instrument, where they've got some characteristics of debt and some characteristics of equity. But in this case, where the company has already raised capital by selling bonds and selling preference shares, these preference shares are also acting like debt, because preference shares aren't ordinary share capital, so they're not the actual shareholders of the company. Okay, so these two amounts here are going to be your debt part of the right-hand side of the accounting equation, owner's equity plus liabilities. Okay. Then the next important thing you must remember when we are valuing just the equity, the company's weighted average cost of capital is 15% and the cost of equity is 17%. So we know that our weighted average cost of capital is calculated by taking a weighted average of all of our sources of capital, which would be the equity plus all of the different sources of debt. We weight them and we work out that 15%. When we talk about cost of equity, that is the cost of only, whoops, why did that go up there? I don't want that anymore. That is the cost only of the equity in our balance sheet. Okay. So when we are valuing the company as a whole, the debt and equity, we need to use the WACC, the 15%. Okay. And the company wants to issue 3.5 million shares. Then we've determined that the company's current cash flow, so remember when they talk about current, that is at time 0. Current cash flow is 3.8 million, and it's expected to grow at 7% for the next 5 years, which is our initial growth period, after which it is then expected to grow at a constant rate of 4% into perpetuity, forever and ever, per annum, okay, which will be our terminal growth. So this is the information we now need to begin our calculations. Our RAND value currently of free cash flow is 3.8 million. For the next 5 years, it will grow at a rate of 7%. And then from year 6 onwards, it will then grow at a rate of 4% per annum. Okay, so everybody happy? You've understood all the information that we've got, and we understood what we're going to calculate. And we have thought about the formula that we're going to use to do this, and we've got all our ducks in a row. Okay, so now let's go and have a look at what the calculation is. Guys, you'll see, unfortunately, on this memo, I have typed in all of these corrected answers already, but the original memo was incorrect. So these blue amounts are the corrected values, okay? So this is what we then do. We start out, so we've got year 1 to 5. We want 5 rows over here. The initial growth period is for 5 rows. We start from year 1, not from time 0. So in year 1, our free cash flow is going to be the current value of 3.8 plus 7%. So in other words, next year, year 1, our free cash flow will be 4,066. And then we take that amount and we grow it by 7% for each of those years, and you do that for 5 years. So you can just write this. You must know what your what your table looks like when you do this calculation. So you want 3 columns, and just complete this first column to start with. Number your years so that you know how many years, because often students will do the incorrect number of years. So write those 1 to 5 down. Make sure you've double checked you've got the right number, and then do this calculation to get your cash flow for those 5 years by growing it 7% for each year. Then we've got to calculate the present value of these first 5 years. So we are going to use the 15%, which was our WACC cost of capital. So this is your present value factor for 15% and 1 year, 15% and 2 years. So you can look this factor up on your tables using the 15% column and row 1, row 2, etc. That's the quickest way to do it because you will have tables in front of you, and it also ensures that you don't make a finger mistake on your calculator while you're calculating these present value factors. So practice using your table. Again, make sure you're using the correct table. It must be the present value of R1 table, and just double check that you are using the correct column, that you've picked the right the right percentage column, and that you've used the correct, put the correct factor next to the right year, and then you just multiply that out. So the free cash flow amount for year 1 multiplied by the present value factor for 15% and 1 year, and then that gives us the 3537. And then you multiply that out for the 5 years, add those 5 present values together to get the present value of that initial period. So if you just picture what that formula looked like that we looked at just now, this table here is the calculation for that that first part of the formula. Monica, yes, you got a question?
Hi, ma'am. Can you hear me?
Yes.
So I got a question, right, based on the tables that you're doing. So something I picked up is that when the question says calculate the present value at the end of each year, right? The present value that is used is the one that we find in the table. And then when it says present value, well, when it says calculate the present value at the beginning of the year, they start with 1 and then follow the factors. The same thing with future value. It does the same thing, but then it starts from year 4 going up. Can you maybe please explain that when you get a chance? Like, I just want to understand why they start from the bottom, then up, and then when it says begin, why do they start with 1 and then follow the present value factors? When you get a chance, after you explain.
I can help you quickly there, just for you to go and have a look at.
Right.
That if you're starting at the beginning and you're working towards the end, that is when you are working out a present value. So in other words, the present, we're working from year 1 is going to be closest to the present. So I'm
when
taking
it's begin mode.
Yes, you would use only you will use that beginning. When do we use that for an annuity? You only use that begin mode for an annuity, okay? Not for a mixed stream of cash flows.
Okay, cool.
Okay, so you'll use the percentage and the present value factor for 1 if you are present valuing year 1. Because then what you are doing is you are taking the money that we received at the end of year 1, and I'm going back to the beginning of year 1. So I'm going backwards 1 year. So it's year 1, and then each year below that will be year 2, year 3, year 4, year 5 on the tables.
Okay, cool. No, it makes sense. And then sometimes I also picked up that when it's future value at begin, then year 0 would get the first year's amount. Whereas if it's present value, it's still zero, if I'm making sense.
No, I understand you correctly, and you've picked that up. That's good that you've picked that up. So we only put an amount in our calculators for year 0 if there is an initial amount that's paid. So for instance, like in some of our capital projects, there is an initial outflow at the beginning of year 1, which we then write down as year 0. Then you've got a rand value in year 0. But if the first cash flow takes place at the end of year 1, then year 0 is nil, and only put that amount in from year 1 and an amount, and year 2 and an amount. So we only use year 0 if there is an initial amount that is paid out or in at time 0.
Okay, cool. No, it makes sense. Thank you.
Okay. No, those are good questions. Yeah, those are good questions, and I can hear from that you have been looking at these because those are those little funny things that you need to pick up. Okay. Okay, anyone else got a question at this point before we look at the rest of the calculation for this? Everybody okay so far with also the other thing, this format that we're looking at for this free cash flow, this table that we've using, please guys, if you get a question like that, use this table format. You can see how beautifully it lays the information out. You can see exactly what you're doing. You've got a row for each year. You've got your column for cash flow, present value factor, and the present value cash flow, and we've got our total. There is one question in the textbook, and I think it is the one in the chapter, and I don't know why they do that. They've got that horrible method where all the calculations are done in like one continuous row. And I don't know why anybody would want to do their workings like that, because you can't see what you are doing. There is a question, I think it's one of the revision questions in this chapter, where, and it is in your textbook in the solutions, where you'll see they've used this table. It's by far the easiest method to do these questions. Whether you're doing that dividend growth model formula or whether you're doing the free cash flow valuation model formula, it should look like this. So then we've come to the end of our initial 5 years, and we've got that 15,000. So now the rest of our formula says, now for the rest of time in perpetuity, our free cash flow is going to grow at the rate of 4%. So what we do is we take the last cash flow that we worked out, in other words, year 5's cash flow, and we grow that instead of carrying it down. So in other words, year 6, instead of taking year 6 and growing it by 7%, we're taking this amount from year 5, and we are now going to grow it by 4%, but in perpetuity. So this is your present value of a perpetuity formula. If you go back and look in your learning unit 2, learning unit 2, time value of money, formula for perpetuity, you'll recognize this formula here. So we are saying that free cash flow at the end from year 5, we are now going to grow it by 4% every year. So it's plus the second growth percentage over R minus G. Okay, so R is our 15%, minus G is our growth, which is 4%. And then we multiply that by 0.497, which then present values how can I put this? It sounds strange to say present values, the present value. Okay, if you ignore this 0.497, but you look at the rest of that formula, 5329 plus 4% over 15% minus 4%. That is a present value of a perpetuity formula. But because this is from year 6 onwards, we've got to take that value and present value it to here. Okay, so that's why we then multiply that by 0.497. And you just use the same factor that you used for at the end of year 5. Okay, so we then calculate the present value of the terminal cash flows at 22.977 million. Then we add the 15 million, the initial present value, plus the terminal present value to get the total value. So remember what I told you, this total value is the right-hand side of our accounting equation, which is owner's equity plus liabilities. Okay, that's 38 million. So we can't take that whole value and divide it by the number of shares that we've got, the 3.5 million, because then we are taking the 100% of our asset value and saying that that's how much each share is worth. And we can't do that because part of the assets belong to our investors that have lent us money. We can only use the equity part of the company to value the actual ordinary shares that we're going to issue. So we now take that total value that we've got, the 38 million, we subtract any long-term liability values that they've given you in the question. So in our case, it was the corporate bonds and the preference shares. And what's left is then the total value of the equity. Okay, so this total value here is owner's equity plus liability. It's equity plus liability. And we want equity only. Okay. So if you understand why we're doing that, then you won't just do this like a parrot, and you'll remember when you look at the question why you've got to do that. Then once we've got the value of the equity only, we divide that by the number of shares that we want to issue, and that will give us a suggested initial list price per one share. Okay. So you can see with this question will flow nicely if you remember your table, the layout, the top table, and then what you do in the second table. Add the two amounts together, subtract your debt, long-term debt, and then divide the equity value only by the number of shares that we want to issue. Okay. You guys okay with that question? Any observations or questions or anything about that one? You guys have followed that. Okay. And remember, you can always come back because you will have this recording to look at. Okay, so then we can go on to our last question. Question 5, and this question 5 was worth 70 marks. Question 4, how much was that worth? Question 4 was for 35 marks. So our question 5 is going to be for 70 marks. This one is from Learning Unit 6, which is the capital budgeting applications. Okay, so as soon as we see this first sentence, we know exactly where this question is going. Klopp is looking to increase its production capacity in order to meet the forecasted demand for its product, which has seen an increase in sales as a result of the success, etc., etc. So then immediately we see that, we know that this company is considering purchasing a new machine. In this case, it's to increase their production capacity. And then they have to give us all the information about the productivity of this new machine, what its new costs are going to be, what the inflation is going to be for each year that of useful life of the machine, and all that other information. Okay, so this is why it's this question is worth a lot of marks, because there are several tables of workings that you have to do in order to get to the final answer. But again, with these questions, you must memorize the format. What does my answer look like and what belongs in each of those tables? And then without a doubt, you will get the majority of the marks, even if there are method marks. If somewhere along the line you make a calculation error, if your table is correct and it includes all the information that must be there, even if the amounts are wrong, you'll get the majority of the marks. Okay. Machine annual production capacity in the next 3 years, that's our demand. Okay, we'll come back and have a look at all this other information just now. So let's just have a look. Here's additional information. Always, please, guys, remember this additional information is important. There's stuff here that you have to take into account when you are laying out your work or doing your calculations. I've seen in the newest papers they are using 27% for the tax rate, so don't assume that it's still 28. Look at the paper they've given you and you use whatever percentage they've given you in the question. In this case, the corporation pays tax 1 year in arrears. That's important. They will always tell you that the tax is paid in the year in which the cash flow occurs, or it will say the tax is paid 1 year or 2 years in arrears. So that's just important when you're putting the cash flow part of this question together. Ignore that. Our capital allowance, we always want to know what we are going to use there. So this is going to be 4-year period, 40, 20, 20, 20. Capital gains 80% in case we need that. WACC is 6% that they use to appraise capital investment. So for 29 marks, calculate the initial investment for the new machine together with the working capital requirement. Because remember, if you remember that this part of the chapter that we did, every capital project is going to have an initial investment that we've got to calculate. Then it's going to have the operating brand values for the years of operation for its working life. And then it's going to have the terminal value at the end of its working life. So in this case, they've asked us for the initial investment. And remember carefully, initial investment always includes, so who asked me just now, Monica, this initial investment would be an example of a cash flow that you would put down as occurring at time 0. And its value would be multiplied by 1 to work out the present value. Initial investment will include the purchase price and all other directly attributable costs to the purchase of the machine, plus your initial working capital investment. Only that working capital investment that takes place at time 0. Okay. Also, please, guys, 2 decimal places. They hopefully should tell you in most questions to round off or to however decimal places, and you must stick to that. So we want 2 decimal places. And then for 41 marks, we must calculate the income after tax for Klopp Limited for this machine. Okay, the after tax income. So read this carefully because they can ask you for to work out the cash flow from the machine, or they can ask you for the income after tax for the machine. And remember, your cash flow is not the same as your taxable income. And it's all in your questions in your textbooks. Okay. So let's just go and have a look then. We know now what we've got to do for those 70 marks. We've made notes of this important information, and now we've got to go and have a look at what are we going to. So first of all, initial investment. Cost of the machine. So we want the cost of the machine. That's the initial investment. Delivery costs is directly attributable. We must include that. And import duties is also directly attributable to initial costs. So we must include that as 10% of the purchase cost. Okay, so all of that will be initial, but we also have to calculate the the table for the working capital, so that the initial working capital investment must also be included in our initial cost. I just want to check something here. Okay. The new machine has got an annual production capacity of 80,000 units, and we are going to use it for 3 years, after which is expected to be sold at its estimated scrap value of 1,750. So this sale of the scrap value at the end of year 3, that would be our terminal cash flow. Our existing machines have already got a production capacity of 120,000 units between them. So only any excess demand that we can't now cope with will be produced by the new machine. Okay. So forecasts for our number of units over the next 3 years are 195 units, 205,000 units, and 220,000 units. So the first 120,000 units of each of those 3 years will be produced by the existing machine, and only the difference will be produced on the new machine. And remember, the new machine has got a limit to its capacity of 80,000 units. It can't make more than 80,000 units per year. So if whatever this amount is minus the 120 is more than 80,000 units, we are limited to a maximum of 80,000 units on the new machine. Then management have estimated that if the new product were to be sold to customers today, so today is also at time 0, year 0, and we want year 1, year 2, year 3, it would have a current, and they repeat that, year 0 selling price of 80 Rand per unit. Okay, we want selling price for year 1. So remember, you've got to read the wording carefully. We're going to have to grow the 80 Rand to get the selling price for year 1, year 2, and year 3. A contribution ratio of 75%. So in other words, if the contribution ratio is 75%, then our variable costs will be 25% of the selling price. Price inflation, so that's our selling price, is expected to be 10% per annum for sales, and 5% per annum on variable costs. Okay. Fixed overheads will increase at 6% per annum each year, but only from year 2 onwards. Fixed overheads are expected to amount to 220 in year 1. So 220 in year 1, and then year 2 we're going to grow it by 6%, and year 3 we'll grow it by 6% again. So this really just tests your attention to detail and your ability to sort information and work with it accurately and carefully when you are presented with a bunch of information like this. Okay, here's our working capital information. Additional working capital management has indicated that based on historic trends of the company, the working capital requirement at the start of each year will equate to approximately 30% of total variable costs linked to the production from the new machine for that year. So now we know what we've got to calculate to get our working capital Rand value. We've got to do a table that will give us the variable costs for year 1, 2, and 3, and then we will take 30% of each of those years worth of variable costs, and that is then the total working capital required at the start of each year. Okay. And then that's the other information that we've got. So let's go and have a look at our answer table. 4.2, that was that debt versus equity question. Just take note of the marking instructions. Students must have indicated correctly whether amounts are an inflow or an outflow in each respective year as per your calculations. And that goes for all of your workings. any question. Brackets if it's a cash outflow or a negative amount. No brackets if it's a cash inflow. For working capital, year 3 must be shown as an inflow because at the end of the year, all of the working capital that we initially had to invest in is released. Okay, so initial investment. So here are all those amounts that we highlighted. The cost of the new machine, the 4.5 million, plus the delivery costs, plus the import duties, which was 10% of the original cost. Then when you do this table, you will always, it will be these items and always include a line for working capital requirements and then your total. I remember marking this last year and I was very surprised at how many students didn't write down a total. So I don't know what they were thinking about. Okay. You must have a total so that you know what your total initial investment is going to be. So make sure you know what information is going to be included in your initial investment table. So we've got all that information except in this working capital requirement. We've got to do a calculation in order to get that. So remember, they said working capital will be 30% of total variable costs. So you can see in this table here, we have made a column for each year, year 0, and then 1, 2, and 3, because remember this initial investment takes place at year 0. Okay, this 5722500, that is at time 0. So we want to know at time 0 what rand value will our working capital increase by. So that's why we are going to put that initial amount that we calculate. So 30% of year 1's variable costs will occur at the beginning of year 1, which is a time 0. So you can see this table, what we are aiming at is to calculate the total variable costs for each year, then calculate 30% of each of those amounts, which is then the working capital requirement for that year. And then they said that is the amount that we have to invest at the beginning of each year. So the working capital that we require to use during year 1, we have to invest in at the beginning of year 1, which is time 0. So 472.5, our working capital. So that is an initial cash outflow as we increase our working capital. Then during year 2, our working capital must increase to a total rand value of 529,200. So the difference between these two amounts is the amount by which working capital is going to increase at the beginning of year 1. And then during year 3, working capital must increase to a total of 555,600. So the difference between year 2 and year 3 is that working capital needs to increase again by another 26,400 at the beginning of year 3. So this is the beginning of year 1, the beginning of year 2, the beginning of year 3. And at the end of year 3, the total rand value of working capital is then an inflow again. Because when our project ends, all of that working capital is released back into our available cash. So our calculations to get to total variable costs, I'm sure you guys will manage that. We have to work out how many units the machine is going to make for each year. So remember I showed you the total forecasted requirement minus what the current machine is already making leaves us with the number of units that the new machine must make. These 2 years, the remaining requirement was more than 80,000. So remember, you are limited to a maximum of 80,000 units each year. Then they said that, what was this 80 Rand? 80 Rand was our current selling price, if I remember correctly. Variable costs are 25% of the current selling price. So variable costs are at time 0, 20 Rand. and that is going to increase by 5% in year 1. So we've calculated that variable costs in year 1 will be 21 Rand per unit. And then that increases by 5% in year 2 and by another 5% in year 3. So we've got our variable cost per unit for each year. So we take the number of units that our machine is going to make, multiplied by the variable cost that we've calculated, and that's how we got those total variable costs. Multiplied by 30%, and then we've already looked at how we get that amount. So initial investment, we then want to take this initial cash outflow at the start of our project and include that amount in our initial investment to get the total initial investment. Costs, all the direct costs of the machine plus the initial cash outflow for working capital is the total initial investment. Okay. Then the second table was they wanted us to work out the, what was it, the taxable income, the income after tax. Income after tax. Anybody got any questions with that? Let me just have a look. Christopher says, just want to confirm that with that loss of 25,000 units, you don't indicate it. Is that the number of units that we can't make on the new machine? 220 minus 80. Yes, you just ignore it. You don't do anything with that because we basically, it's an irrelevant amount because we won't be making those units in our business. So yeah, we don't go into that whole calculation of lost opportunity cost, etc. Yeah, in this particular one. So yeah, for these questions, ignore it. I think in second year there was a question where we had to take that opportunity cost of the lost units into account somewhere, if I remember correctly. Don't worry about it here. Okay, that's also a good question. Monica says this is the same as revision question 5 in LU6. I think you're right. There is a question exactly like this in the textbook. This question does come from the textbook, definitely. So let's have a look at our second table for calculating the after-tax income. So, okay, I won't remember all those references, but let's just see. Okay, so the first thing we've got to calculate here is our contribution per unit. So again, remember that 80 Rand was the selling price at year 0. We want the selling price at year 1. So that has to increase by 10% to get year 1 selling price, 10% for year 2, and another 10% for year 3. Then we've already in our working capital table worked out what the variable cost Rand value is for those 3 years. You must use that variable cost that we've already calculated and not just, and you can't in this instance just say that variable costs are 25% of the selling price, because that 25% was only true at year 0. Okay, so we've increased the selling price by 10% each year. And remember, we increased our variable costs by 5% each year. So that would have changed that ratio of 75% for contribution and 25% for variable costs. So you can't use that. You have to physically work out the Rand value for each year. So then our contribution is selling price minus variable costs equals contribution per unit multiplied by the number of units, which again, we've already worked out in our working capital table. How many units is the new machine going to manufacture each year? Contribution multiplied by number of units is our total Rand value contribution for each year. We only subtract fixed overheads, fixed costs come off contribution. And remember, in that case, they said in year 1, it's 220,000. And then fixed costs will increase by 6% in year 2 and year 3. And take note here, selling price was positive. Variable cost has got a brackets minus to show that we subtracted it. And here again, we've put brackets around fixed overheads to show that that is being subtracted from our total contribution. Then, because we are calculating taxable income, we must deduct the capital allowance, which is our allowed tax deduction from our income. Remember the capital allowance 40-20-20 must only be on the direct costs of the machine, not on the working capital. So the purchase price, the duties, and the what was this delivery charges, those three amounts. So our capitalized cost of our machine is 5250. So we're going to take 40, 20, and 20% of that value of the machine only. Okay. And then that gives us our taxable income. So there's no other funnies in this question other than contribution minus fixed overheads minus capital allowance equals taxable income. And then this memo was incorrect. In this memo, they've muddled up cash flow with taxable income. If the table had have asked for the cash flow, we would then have put the tax in the year following the year in which the tax was calculated for. Okay. This is not cash flow. They said, what is the taxable income for each year? So therefore, we've calculated the taxable income multiplied by the 28%. That would be deducted from the 2705. So our income after tax for year one would be the 1947. Okay, and then the same for the other 2 years. So that's where I've put this arrow. This tax, because it's income after tax, the tax must be written the year for which we calculate the tax. Okay, it's not cash flow. Don't muddle cash flow up with income after tax, like whoever drew this paper up did. And that's the end of the memorandum. Okay, so what did everybody think of the question? Yeah, I don't know. Honestly, Christopher, if you and Prema, you guys are 100% correct. Some students are terrified of these questions because they just look at the answer and they see all these tables and how long it is, and that frightens them. But if you think this is 70 marks of your 180 marks, this is a gift question if you've practiced these questions and you know what to do with the information. Because really it's common sense. It's being very careful, attention to detail, and just making sure you're following the instructions carefully. And also remember, and I'll show you now on the memo, there'll be lots of method marks in this question. Exactly, and if you can get these 70 marks, you can make up if there's a question somewhere in the paper that you're battling with. Yeah. It is a lot, but don't let it frighten you. When you practice for your exam, you just practice, what does my initial cost table look like? What must I include there? For your working capital, they'll tell you in the question what calculation you need to do to calculate the working capital. In this case, it was 30% of variable costs. It could be 25% of contribution, who knows what. Okay, so again, just follow. And then there are, in these questions in your textbook, there's 2 other tables. The one is the cash flow table, and the other one is the taxable income. No, that's all, but they can, yeah. And I think there is one other question in the textbook too, where they give you, I'm sure you guys have seen it, maintenance costs and electricity costs and water costs. And then they tell you that this one increases by 2% and this one's got inflation of whatever, and this one decreases after 2 years. If they give that to you, remember, you just work it out line by line and you just again follow, you've just got to read these carefully. When does that increase or decrease take place? Which percentage is it? From which year must you apply that percentage? No, we don't know, but I don't think that your exam papers are going to be too different from what we've seen before. So I don't think you need to panic. I don't think you need to panic. If you've practiced all of these questions in the textbook and all of these questions that we've done before, and you know your methods, you know your formulas, you know what to put into each of your formulas, then you know, no panic. I promise you, like they'll say with anything else, if you get caught out in the sea and you start panicking, it's the panic that will drown you. If you keep your head clear, you'll get out of the water. And remember, it's exactly the same with this. It's the panic that will take you under. And I know what it's like, guys. I can remember that horrible nervousness and anxiety when you sit in an exam. Your biggest task when you sit down is to first calm that nervousness and the anxiety before you start writing. Fight or flight is 100% correct. You've got to make it fight. So you've got to use all that adrenaline for fighting, not for running away. So it's good to be nervous, but just don't start overthinking everything. I can also see when I mark a paper that the student has been looking for tricks under every question and they've overthought it and they've started again, then you just start getting yourself off track. Yeah, this was a very nice paper. Say this was last year, and I don't think your paper this year is going to be, when I say any different, obviously the questions will be different, but similar style. You know, remember they have to ask you your learning objectives. So they can't ask you weird and wonderful stuff that isn't in your curriculum. They have to ask what's in the learning objectives. Cameron, I don't think particularly, because I think if I remember correctly, your tasks were very sort of research heavy, theory heavy. It was you guys that had that infographic and all that kind of stuff to do. So I don't think you need to do that. Rather stick to your textbook. Make sure that you use the examples and your formulas and the questions in each chapter, and then very much the revision questions at the end of each chapter. You've got the question bank at the, let me just double check, has your textbook got that question bank, the extra questions at the end? Yeah, you can look at the question bank and then just a couple of exam papers. This is your last collab, and it would actually be your NSS as well, which is why I've been covering exam papers in the last two. So if you have a look at your timetable, you'll see week 16, the 4th of June, collab, 6 o'clock NSS for exam. But if you guys, because you guys are writing on the 21st of June, so you've got just less than 3 weeks. If there's anything else, any questions or anything else that you guys need during that time, you're welcome to give me a shout. But remember, I have linked in your announcements, you've got 4 full exam papers in YouTube and recording. So I really don't start overthinking. 4 is more than enough to practice with, that you've got, and your textbook. And then if there is another exam that you want to test yourself with that isn't there, then download it and test yourselves with that. But don't start panicking or overthinking. Okay, guys, I'm glad you all said that it's helped you a lot. I'm happy to see that. And remember, when you're revising, you're welcome to ask me questions at any time. Yes, guys, good luck. And yeah, remember, I am available from my first group writes the exam on Monday. So I will be marking from Monday. So I am available, looking for your questions. Awesome. Thanks, Christopher. Nice to know. Thanks, Claude. Everybody else. And it's been lovely to have you all this semester. I'll miss you guys. It's nice to have a class where there's a group of students that come regularly to collabs and give feedback and participate. So that is nice. Okay, guys, all the very best for the paper. I look forward to marking it. And yeah, I hope you guys do well. Thanks, guys. You guys too. All right. All the very best, guys. Get better, Christopher. All right, everybody. Bye.